Innovate. Enable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to the Mutual Fund Day Family Financial Plan series on CNBC TV 18. This is the series that puts the spotlight on individuals who have been handpicked from across India for their financial planning. Our featured investor today is Sanjeev Kela from Chandigarh. So to kick off the show, let's take a look at the Kela family's financial planning journey.
On this episode of Mutual Fund Day Family Financial Plan series, we bring you the financial case study of Mr. Sanjeev Kela, a businessman from Chandigarh. He lives with his wife Smriti Kela, a private tutor, son Tarun who's pursuing his education, and daughter Shruti who works as a legal consultant.
My investment journey started in the year 2003 when I started operating this petrol pump, and I was able to have some savings for which I had really no idea how to invest that for my future. And that is where this concept of mutual funds was catching up at that time, and I moved in that direction. It's been a long journey, and I think it's been very fruitful for me.
Mr. Kela started his investment journey with mutual funds in the year 2003. Majority of his assets include mutual fund investments.
My short-term goals were essentially settling my children. So my son is in the process of completing his education. His education loan has been paid off, and he's been able to obtain again from employment also, which he'll be joining somewhere later this year. So he'll take care of the rest of his own expenses. Yes, I do need to create a corpus for my daughter's higher education, which is one of my short-term goals. In the long term, I am essentially interested in creating a corpus for my family and the future generations. We have whatever we require is being looked after by my income from my work. So the idea of investment and saving is actually saving and to create a corpus for the future.
Sanjeev and Smriti aim at building a corpus for their long-term goals. They aim to achieve their goals with structured fiscal planning and assistance from a financial planner.
As a mother, I will say I have to get my both children married. So I'm looking towards that also. And when we started the investment, we had some problems in the business also. And this investment of ours, the returns which we got at that time, they really helped us to sail through those bad times.
It's been fairly good. I think I started very late. I would have been happy to start earlier, but I was not aware. So once I became aware, and then I became more secure in this, and there were certain challenges I faced in my professional career. And at that time, whatever my savings were in the mutual fund industry, they did help me in pass that time over, those tough times over, So that was a great time when I did this.
All right, so that's the broad overview of the Kela family's financial planning journey. Let's take a short break right now, but on the other side, we'll be analyzing that journey, and helping us on this episode will be our guide, Anish Jindal, an independent financial planner. Stay with us on CNBC TV 18.
The mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series on CNBC TV 18. Now, before the break, we took you through the financial planning journey of the Kela family from Chandigarh, and now we are going to analyze that journey. We are, of course, joined by Sanjeev Kela himself and by our expert Anish Jindal, an independent financial planner. So welcome, gentlemen. And first up, Sanjeev, I want to begin with you. When did you really start thinking about financial planning?
This was about 2003. I had started a new business, and we were accruing certain savings, and I needed a way to park it in a place where it will grow. So that is where thinking about mutual funds and those sort of things came in.
And your initial analysis of Sanjeev's financial journey?
See, in fact, when I started working on his the total overall portfolio, it was almost 2.5 years back when we discussed about the complete portfolio, and it was like he's invested in quite a lot of asset classes. It was a diverse portfolio, but we have to actually then consolidate the complete portfolio.
Right.
Then we discussed about it, and basis his investable surplus, basis his risk appetite, when we actually come to a conclusion that we need a balanced portfolio in his for his family. Then post that discussion, we actually then consolidated, then we have rebalanced the funds that he have invested over a period of time. Then we have actually taken 50% equity and 50% debt kind of allocation to create a balanced portfolio for him. So that was the initial thing that we have discussed about his portfolio.
All right. So how did you get into mutual funds? Did you have a financial advisor who told you to try mutual funds? Did you ever try the stock markets?
I did try the stock markets at the time, yes. I did not have any formal advisor, but in that era we used to have a lot of bankers who were pushing mutual funds, and there were a couple of them. We had a good relationship who advised me. They had evaluated my appetite towards risk to whatever way they could do it, and they suggested that I should move into the mutual fund spectrum rather than investing into shares or any other area.
Right.
And that is the way I was introduced, and I started on with the mutual fund journey.
Right. And he's gone on and invested almost 100% of his savings into mutual funds. Is that a wise thing to do?
See, typically we normally advise different asset classes not to put all the eggs in one basket. While he is invested in mutual funds, he's got some investments in real estate as well.
Right.
Right. So the portfolio which I'm managing as of now is 100% into mutual funds as well. Why mutual funds is it's a pretty simple thing. While we put some money into equities, we just wanted to create a portfolio which is little safe compared to direct stock investments, right? So that's where we have actually picked up equity mutual funds, right? Then the fixed deposit portfolio that he had, the fixed deposit investments that he had, to ensure the better tax efficiency, we have put that money into debt instruments, right? So I don't think so there is any harm in case he's putting up his portfolio into mutual fund, because that itself is a diverse field, wherein we can actually put our money into different asset classes, into equities, into debt, and into short-term or liquid or treasury funds as well.
But what is an ideal diversified portfolio? How many different classes should one be investing in?
See, while we speak about different asset classes in the portfolio, majorly there are two things. One is equity and one is debt. Then in equity, yes, we can actually invest into large cap funds, which gives us stability to our equity portfolio. They are not that volatile compared to small or mid cap funds. Then yes, considering last 2-3 years, we have got very good returns in small cap and mid cap category, right? So that has really helped investors to kind of create good wealth, right? So we have to have that allocation into large cap, mid and small caps, and of course some sectoral funds as well.
For a first-time investor, there is a plethora of options out there, even if you're talking just about mutual funds. So how does an individual really identify what's a good fund to put your money in? How many years of track performance should you really be looking at?
See, normally if you ask me, we look at a track record of 5 to 10 years, right? Whenever you are investing into any equity-based mutual funds. So it's always better you have to have a time horizon of 5 to 10 years. So I think you should at least look at 5 years kind of return, right, while you are choosing any good fund. And you should also look at not only the return, 5-year returns, you should also look at all these funds. They should be kind of every year they are giving the same kind of return, right?
So let's talk a little bit about liquidity and the safety net that mutual funds can offer. And I believe there has been an instance in your life when mutual funds bailed you out of a tough situation.
Yes.
Why don't you tell us about that?
See, there was a situation where I had faced a tough challenge as far as my business was concerned, and I was literally without any income for a period of time. And during that period of time, whatever money I had invested into the mutual funds, it was so convenient for me. Just on a redemption, on a request redemption, I would get the money on the second day or the third banking day, and that made me sail through those tough times. So the liquidity or the ease with which you can invest or you can get your money back is probably the best thing about mutual funds. I think for anybody who is investing into any type of, I was not bogged down into fixed deposits or losing interest. I was not bogged down into property where there would be a gestation period before which I would get my money back. It was simply putting in a request and getting my money into my bank account on the third day, which really saved the day for me during those days.
Right. And Anish, what's the time horizon that one should be thinking? Because a lot of people think that mutual funds is a way to make quick money. So, a lot of people mistake it for trading in the stock markets and think that we can either lose or gain money on a daily basis. So, tell us about the time horizon and really when does the power of compounding kick in?
In fact, anybody who's like looking at the quick money in mutual funds, this is not their ballgame altogether. You should at least look at a time horizon of 8 to 10 years in case you really want to reap the benefit of that compounding as well, right? And if you really ask me, somebody who's a starter, who started earning, like at the age of 24, 25 people, they generally start earning. So my advice is start putting some small money every month, right? Maybe through SIP route. Over a period of next 20 years, 30 years, you will actually see your money growing like anything. Like a small amount of 2,000 rupees, in case you take it 2,000 rupees per month invested into any good equity-based mutual fund, right? Over a period of 30 years, if you calculate the returns, right? In 30 years, you end up investing 7,20,000 rupees, right? With the power of compounding, with the 12% kind of compounded returns, the money will actually becomes more than 2 crore. Right, that's the power of compounding actually.
So the earlier you start, the better.
Earlier you start, the better you, of course.
All right. So start out young, and on that note, we are going to take a short break. But stay with us because the conversation continues on the other side. Stay with us on CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series on CNBC TV 18. And we are here having a conversation analyzing the financial planning journey of Sanjeev Kela and his family from Chandigarh. Gentlemen, let's do a little bit of crystal ball gazing in this segment, and perhaps let's look into retirement planning the next 10 to 15 years. You have retirement goals set for yourself financially?
Frankly, in my line of business, we don't retire. We just pass away, So, but having said that, yes, I do have a target of retiring in about 10 years from now. I intend to build up a corpus, which will essentially look after my post-retirement benefits. By that time, I'm sure my children will be capable enough to take care of themselves. And post that, I'd like to leave a corpus for them and for the future generations.
Right.
That is broadly what my thinking is.
And what's your financial planning for him to achieve those goals?
See, in fact, that's what we discussed. So today what we are doing is we are investing almost 40% of your annual income, right? So that's how we have planned. So now what we are doing is we are creating the balanced portfolio like we discussed earlier. So in that balanced portfolio, we are actually going majorly through SIP into the equity mutual funds, and of course some STPs as well into equity mutual funds. So we are investing systematically every month. That's the disciplined investments that we have created for him over a period of time. That too in a diverse portfolio.
Right. Do you recommend retirement funds, investing in retirement funds?
Typically what we are doing is we are actually creating a corpus for him. We are not saying retirement funds per se. We are saying we are actually investing into large cap, mid cap, small caps, and of course the diversified portfolios, right, to create a corpus for him for the retirement.
Right.
Right. Since all equity mutual funds, we get tax benefits. So anything that you earn after 1 year is all tax free, right? So we really don't want to go into pension funds. Right. So that's how we are creating a portfolio for him over a period of time. And yes, we are putting in money into debt instruments as well, since we want some safety as well for his portfolio.
And what about medical emergencies? Because, that's an age, in old age, you tend to have some medical emergencies. actually at any point in time you could have a medical emergency. So how do you prepare for that, and are there specific assets that you can invest in for that purpose?
Oh yes, in fact we've got some small short-term pot as well, right? While I'm saying we are putting the money into debt instruments, so in debt instrument we have short-term or very short-term debt instruments which are like available anytime. So you put in redemption today and you get your money tomorrow in your account, right? So they are as liquid as your fixed deposit or as liquid as your saving account deposit, right? So that is available. Right. And simultaneously what we have done for him is like for any kind of medical emergency, so of course we have taken health plans, right, which gives you that cashless facilities at all major hospitals in India.
Right. And he mentioned earlier that you have invested a little bit in property as well. What was your mindset and your approach towards property? Did you, as most Indians, think that this is a good investment to make?
See, that could probably would have been one of the reasons at that time, but primarily it was because typically Indian, one son, one daughter, so you normally try to build up a kitchen, another additional kitchen. That was what the basic exercise was.
Yeah.
And for that reason, I invested into a property in a nearby area, which has come up, which is rented out right now, in fact. So that is giving its own returns, which again I put it into the mutual funds. So whatever rental I get, I'm investing again. Right. And that is there, and that is about all. I have not seen any major appreciation in that property because I came into the game fairly late, I guess. Right. But my objective was to create another kitchen, and that is what I've been able to do.
So Anish, talking about real estate, would you recommend investing in real estate at this point in time?
See, if you really ask me, real estate, while we speak about asset classes, and real estate is one of the asset classes that we really should invest, right? So yes, of course, I advise my clients to go ahead for real estate investment as well, since we have seen a lot of correction in real estate in last 5-7 years.
Okay. So, and you have 2 children who are both in their 20s. One of them is pursuing higher education. The other one wants to pursue higher education. So are you mapping your financial goals with their life dreams, and how are you really building a corpus for them?
See, for my son, his education is more or less over now, and we have been able to pay off his education loans, yes, and I guess from now onwards he should be able to take care of himself. For my daughter, she is working, she is having her own savings, plus I am building up a small corpus for her also, and I think her requirements would come in the next 2 years. By that time, we should have enough savings for her to cater for her education requirements.
Right. And if you were to look back at your financial planning journey starting 2003, is there anything that you'd like to change? Any regrets?
I should have started in 1983.
Apart from that?
No, I think I have had a good run, frankly. I played safe because for whatever my financial situation was through all these years, I had to be very careful about how I was investing, where I was investing. I had to keep my money secure. Frankly, I didn't have any backups really. So I have tried to keep my money secure for my family essentially, and I have achieved that, yes. I'm really happy with whatever I've done. If I could have got a better return, fine, maybe that's another story, so maybe some other time.
All right. And as we wrap up, your advice to investors, your advice to first-time investors who are afraid of investing in mutual funds?
See, to all investors, my simple advice is just do your disciplined investment every month. And you need not to be scared of investing in mutual funds. So keep investing regularly, keep investing in a disciplined manner every month. Whatever small amount you can invest, you can spare out of your savings right into mutual funds every month. Over a period of 15-20 years, you'll be amazed to see the kind of corpus that you have built up, right? And that's where the power of compounding will actually come into picture.
All right. And for all the couples out there all the families out there who are looking at your financial journey and your story, your advice to them?
Start early, start as early as possible, because the opportunities you will be getting all throughout your journey will be fantastic. And it's a very, very safe way of investing. I think it's better than any other way of doing it. Don't be greedy. Just don't be greedy about it.
All right. Thank you so much for joining us on the show today, gentlemen. It's been a pleasure talking to you. And with that, it's a wrap of this episode of the Mutual Fund Day Family Financial Plan series on CNBC TV 18. We'll be back next month with another featured investor and his or her exciting financial planning journey. Stay with us on CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.